If you're considering a move abroad, you've probably compared tax regimes, residency programs, and quality of life abroad. But did you ask yourself this first? What will my current country charge me for leaving? Exit taxes are a government's way of disincentivizing your departure from their tax net. You may not have sold any assets, but the tax comes due anyway. For anyone building a global mobility portfolio, exit taxes are an oft overlooked cost that can wipe out years of planning. In this video, we've mapped the rules across major jurisdictions, so you know what you're dealing with before you make your move. Before we talk about each major country's exit tax structure, we first have to talk about how they work. The mechanics are consistent across jurisdictions, even where the details vary. On the day you relinquish tax residency, or in the case of the United States, the day you renounce your citizenship, the government performs what's called a deemed disposition of your assets, your stocks, business interests, real estate, and in some countries, retirement accounts are evaluated at fair market value. The difference between that value and your original cost basis becomes a taxable capital gain. As such, you are taxed on wealth you have not yet realized, at rates ranging from 15% up to 42% depending on the country. Some governments allow deferral, others demand immediate payment or collateral. A few will pursue you for years after you leave. But two broad models exist. The first ties the tax to a change in tax residency. In other words, you move and lose your resident status, and the exit tax kicks in. The second model, while limited in practice to the United States, ties the tax to citizenship. Americans cannot escape worldwide tax obligations by moving abroad. The only way out is renunciation, and that triggers its own exit tax. We'll talk about the US later in the video, but first, let's jump up north to Canada. Canada's departure tax applies to any individual who stops being a Canadian tax resident, regardless of citizenship. The government deems you to have sold most worldwide assets at fair market value immediately before departure, and the scope is unfortunately wide. Stocks, mutual funds, cryptocurrency, foreign real estate, partnership interests, and private company shares all fall under deemed disposition. However, Canadian real estate, registered retirement accounts like registered retirement savings plans and tax-free savings accounts, and your principal residence are excluded. These capital gains are taxed at a 50% inclusion rate, meaning half of any gain is added to taxable income and taxed at your marginal rate. Former Prime Minister Justin Trudeau proposed in his 2024 federal budget to raise the inclusion rate to 66.67% for gains above $250,000, but this was deferred, then cancelled entirely by current Prime Minister Mark Carney. But the lifetime capital gains exemption, increased to $1,250,000 for qualifying small business shares and farming or fishing property, was kept. For a business owner holding private company shares that have appreciated by several $1 million, the departure tax bill can easily run into seven figures. But here's a caveat. Deferral is available. You can elect to postpone payment until you actually sell the asset by filing Form T1244. If the deferred federal tax exceeds $16,500, you must provide security to the Canada Revenue Agency, typically a letter of credit or a charge on Canadian assets. One advantage of the Canadian system, if you return and re-establish Canadian residency, you can elect to unwind the departure tax on assets you still own, effectively cancelling the deemed disposition. Japan's exit tax, introduced in 2015 for Japanese nationals and extended to foreign nationals from 2020, targets residents who hold financial assets with a combined market value of 100 million yen, roughly $630,000, and who have lived in Japan for more than 5 of the preceding 10 years. That threshold is low by global standards. The US triggers its exit tax at a net worth of $2 million, and most European countries focus on business owners. Japan's 100 million yen covers anyone with a moderately sized equity portfolio, including expats who accumulated restricted stock units or stock options during their time in the country. The tax rate is 15.3%, combining 15% national income tax with a 0.3% reconstruction surtax. A 5% local inhabitants tax may also apply, pushing the combined effective rate to about 20.3%. The deemed sale covers securities, ETFs, mutual funds, bonds, options and derivatives. Cash, bank deposits, real estate and cryptocurrency are excluded. Those on Table 1 work visas. In other words, those in engineer, specialist in humanities, intracompany transferee and business manager categories are generally excluded from the residency count. But if you're on a Table 2 visa, including permanent residents and spouses of Japanese nationals, you are counted. This distinction catches many long-term expats who upgraded to permanent residency without considering the exit tax implications. Deferral is available for up to 10 years, but it requires appointing a tax agent in Japan and posting collateral equal to the tax liability. If you return to Japan within the deferral period, the tax is cancelled on assets you still hold. Now, Norway has overhauled its exit tax rules repeatedly since 2022, each time making them stricter and stricter. The current exit tax framework, shaped by the 2025 national budget, is among the most aggressive in Europe. When a Norwegian tax resident relocates abroad, exit tax applies to unrealized capital gains on shares, share savings accounts, and endowment insurance. A basic allowance of 3 million Norwegian kroner, roughly $310,000, shields smaller portfolios. Gains above this threshold are taxed at an effective rate of about 37.8%. The 2025 changes closed what the Norwegian government called a fundamental loophole. Previously, a departing taxpayer could defer the tax indefinitely and avoid it entirely if they held shares long enough. Under the revised rules, taxpayers have 3 options: immediate payment in full on the date of departure, 12 interest-free annual installments, or a single lump sum payment at the end of the 12-year deferral period with interest. Dividends received while living outside Norway now accelerate exit tax repayment. 70% of any distribution must go toward paying down the outstanding exit tax bill. That closed a strategy where departing Norwegians would strip value from their companies through dividends while abroad, then return and sell their depleted shares at a lower value. Norway also eliminated the ability to credit foreign taxes paid on the actual sale against Norwegian exit tax. Any relief from double taxation must now be claimed in the new country of residence. If the taxpayer returns to Norway within 12 years, the tax is cancelled on assets still owned at the time of return. But the EFTA Surveillance Authority sent a formal request for information to Norway's Ministry of Finance in June 2025, opening an examination into whether these rules comply with EEA free movement provisions. That outcome could force changes to the entire regime. But for now, Norway's strict exit tax rules remain. To the south, France imposes an exit tax on individuals who have been tax residents for at least 6 of the preceding 10 years and who hold shares or financial instruments worth more than €800,000, or who own more than 50% of a company. The tax rate is 30%, combining a 12.8% flat income tax with 17.2% in social charges. For departures since 2019, forgiveness rules have been shortened considerably. If you hold your securities without selling for 2 years after departure, the exit tax is cancelled, provided the total value of taxable securities was below €2.57 million. Above €2.57 million, the holding period extends to 5 years. The French National Assembly voted in 2025 on a proposal to require wealthy nationals to continue paying domestic taxes for up to 10 years after relocating. It fell short by a single vote, but similar measures have been introduced repeatedly since 2019. What will happen next time? Now, Denmark is worth special attention because it has the lowest threshold in the world. At just 100,000 Danish kroner, about $15,500, Denmark catches a far wider range of departing residents than any other country with an exit tax. Unrealized gains are taxed at 27% on gains up to about 79,400 Danish kroner for 2026 and 42% above that. Germany's exit tax targets individuals holding at least 1% of a company's shares. Since 2022, departing shareholders can spread payment over 7 interest-free annual installments regardless of destination. From 2025, the rules also cover investment fund holding above €500,000. The effective rate reaches up to 28.5%. Spain's exit tax applies to individuals who have been tax residents for at least 10 of the preceding 15 years and who hold company shares exceeding €4 million, or a 25% stake worth more than €1 million. Rates for 2025 onward range from 19 to 30%. Those who move to the 24 jurisdictions Spain classifies as tax havens owe Spanish global income tax for up to 5 years after departure. The Netherlands taxes gains on what it calls substantial interests, holding 5% or more of a company's shares. Since 2024, a two-bracket system applies. 24.5% on the first €67,804 of gains, and 31% above that. EU and EEA movers receive automatic, interest-free deferral and pay only when they sell. Austria deserves a mention because it has no minimum threshold at all. If you hold a single share that has appreciated, the gain is taxable upon departure at 27.5%. But for EU and EEA relocations, Austria offers indefinite interest-free deferral. You pay only when you sell. That makes it simultaneously the broadest exit tax in scope, but also one of the least punitive for those moving within Europe. If you want to stay current on tax, residency and citizenship rule changes across the globe as they happen, IMI Daily covers every single one. Check your sovereign score and get our free weekly newsletter to stay abreast. Now, before we discuss the United States' notorious tax trap, let's discuss the rest of the Anglo world. Australia's exit tax triggers when you stop being an Australian tax resident. You're treated as having sold all non-Australian property at market value. Domestic property and business assets are excluded. You can elect to defer the capital gain, but the election is all or nothing. Every eligible asset or none. The 50% capital gains tax discount is prorated for periods of Australian residency after 2012. From 2025, the foreign resident capital gains withholding rate increased to 15% with no minimum threshold. The United Kingdom, on the other hand, does not currently impose an exit tax, but the direction is clear. After abolishing the non-domicile regime in April 2025, reports emerged in 2025 that the government was considering a 20% settling up charge on gains embedded in assets at the point of departure, and the Treasury confirmed it. No formal decision has been made, but anyone with assets in the UK should be paying attention. South Africa applies exit taxes through a deemed disposal on worldwide assets minus domestic real estate, at market value when you relinquish South African tax residency. The maximum effective capital gains tax rate for individuals is 18%. Now, the US is one of only 2 countries in the world, alongside Eritrea, that taxes based on citizenship rather than residency. An American living in the UAE, where no personal income tax exists, still owes the IRS. Moving to a low-tax jurisdiction does not solve the problem. Only renunciation of citizenship does. When a US citizen or a long-term green card holder, defined as someone who held a green card for 8 of the last 15 years, abandons their status, the IRS applies a mark-to-market exit tax to worldwide assets. All property is treated as sold at fair market value the day before expatriation. The tax only hits what the IRS calls covered expatriates. You become one by meeting any of 3 tests: a net worth of $2 million or more, an average annual federal income tax liability above $211,000 over the prior 5 years for 2026, or a failure to certify 5 years of full tax compliance on Form 8854. A one-time exclusion shields the first $910,000 of net unrealized gains in 2026. But above that, standard capital gains rates apply. Retirement accounts get separate, arguably harsher treatment, and IRAs are treated as fully distributed the day before expatriation, triggering immediate ordinary income tax on the entire balance. The consequences reach beyond the person leaving, though. US citizens or residents who receive gifts or inheritances from a covered expatriate face a 40% tax on amounts above the annual exclusion. If a parent renounces and their child is still American, the child could lose nearly half of any future inheritance. This combination of citizenship-based taxation and a punitive exit regime is why few American millionaires actually renounce, even when domestic tax rates raise. For them, the cost of exit is simply too high. So, up to this point, we've covered all the major jurisdictions with exit taxes. But what about the countries that do not punish your departure? Two of the most popular investment migration destinations in 2026, Italy and Portugal, do not impose exit taxes. You can leave either country without a deemed disposition of your assets. So for investors relocating from a high exit tax jurisdiction, this is a tangible advantage when structuring a multi-step mobility plan, because it preserves optionality for future moves without an extra taxable event. Belgium and Switzerland also do not impose exit taxes. Neither Sweden nor Finland charges a tax at the point of departure, but both have clawback rules that preserve the right to tax gains if you sell shares within a defined period after leaving. In Sweden's case, that window is 10 years. So what this means for your mobility strategy is that you must consider it. Exit taxes reshape the entire calculus of international relocation. A move to a zero-tax territorial jurisdiction only delivers full value if you can leave your current country without a steep bill on the way out. Exit taxes generally apply to unrealized gains, which means the longer you wait and the more your assets appreciate, the larger the bill. Pre-departure planning can reduce or eliminate the liability through legitimate strategies like asset restructuring, gifting, or timing the move to optimize multi-year tax averages. Countries that impose wealth taxes are also the ones most likely to tighten exit tax rules. Norway is the clearest example. If you tax wealth annually and wealthy people leave, you need an exit tax to capture the gains they take with them. The UK is considering this action, and we expect more governments to follow. For high net worth investors considering a second residence or citizenship, the question is no longer where to go, it's where you can afford to leave from. In the video linked on your screen, we'll show you where to spend your golden years and pay zero taxes. Sounds too good to be true? Well, 35 countries offer this perk. Thanks for watching. Subscribe for more content like this.